This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello, everyone. Welcome back to a brand new episode of the Smart Property Investment Show. I'm Grace Ormsby, and I can't believe the first month of the year has already flown by, but someone that I've been wanting to talk to for a very long time now, and I'm very glad that we got to get him on today's show, is someone that I'm sure a lot of you have heard of before. He is the Executive Research Director at CoreLogic's Asia Pacific Research Division. Tim Lawless, welcome to the show.
G'day, Grace. Thanks for the invitation. It's great to be on the program.
Tim, before we get into, I guess, the substantive stuff, for those that maybe don't know you or the work that you do, can you actually give us a little bit of a rundown? Because your scope is incredible from my perspective anyway.
Thank you. Well, yeah, absolutely. So I run the research team at CoreLogic. So I work closely with Eliza Owen and Katie Ezzy here in Australia, a couple of analysts in New Zealand, Nook Goodall and Kelvin Davidson. And our research is very much focused on residential housing market trends and the blend of housing trends with economics and demographics, credit availability, all that sort of stuff. So it's fair to say there's never a boring time in this sort of role. I feel really, really lucky to be able to drink from the fountain of CoreLogic's data to provide information and research and analysis to the industry that hopefully helps the industry to make good decisions and for consumers to make solid investment decisions as well.
So here you go. Like, no one better to be hearing this information from. But Tim, as well, like you're looking, you said the demographics, like property data. What data does come into your purview? Because there is so much data out there. What are the things that you do look at or you do latch onto or you're paying attention to?
Man, where do I start? So, I mean, you've got your property data and, the fundamentals of property data tends to be transactional data. So when a home is purchased, it goes through the state government and ultimately ends up in our databases, either through the real estate industry providing it to us directly or ultimately from the state governments. So that transactional data gives us information about how much a property sold for, what type of sale was it? What type of dwelling was it? Was it a house or a unit? How much land is it on? All this sort of stuff. And then on that base level of data, we add a whole bunch of other things like the marketing history, geographical perspectives around, its elevation, how far is it from the coastline or a train station? And then you add a whole bunch of other stuff around, outside of just the pure property data, what's happening in the economy. Interest rates, of course, very topical and interesting. What's happening with credit supply and credit policy. Everyone's following APRA and the RBA and ASIC decisions very closely. We also look at demographic information. So a lot of that comes out of the Australian Bureau of Statistics. Some of the more peripheral data would be, say, data sets coming out of APRA around mortgage arrears or distress, information coming out of, again, the ABS on lending flows, how much value of home lending is happening and what type of borrowers are active or inactive. So, yeah, I think that's just a small sample of the sort of data we tune into and integrate within our research.
Yeah, so cool. That makes me think, I guess, this does feel like a very interesting time period that we've entered into with the property market at the end of 2023 and moving into 2024. And that's basically what we're going to be talking around today, what we did see last year, what we can be expecting from the year ahead. But where does it stand in your mind, Tim, compared to what you've seen over the years? How does this particular period feel?
Well, I think the market's always interesting. It's always doing something. But I think it's fair to say the last few years have been a lot more interesting, for want of a better word, than others. It's been quite the roller coaster ride. If you think about what we've seen through the pandemic, or even the years leading up to the pandemic, where we were going through a lot of changes in credit availability amid macroprudential policy settings and the Royal Commission. And then we moved into the global pandemic, where we saw a huge amount of policy intervention that maybe caught some people by surprise and saw housing values rocketing higher. And then as a lot of that stimulus wound back, we saw values fall, but nowhere near as sharply as what many would have expected, considering the fact that households are still quite indebted and interest rates rose so substantially. But last year, again, I think it really did surprise on the upside in many ways, despite the fact that we saw interest rates lift from their emergency lows in the middle of 2022, getting up to higher than average, higher than the decade average. We still saw housing values in Australia increase by more than 8%. In fact, a little bit more than 9% across the capital cities. Some markets, I mean, Perth is probably the best example, saw housing values rise more than 15% last year. But I think that the main theme last year in 2023 was, well, diversity, probably for starters, because we did see some markets moving backwards last year. Hobart is probably the best example. Darwin values were down a little bit. Canberra was essentially flat. And then we have markets like Melbourne, second largest capital city, only saw, only for maybe that's a bit flippant, but 3.5% growth compared to Sydney, where values are up a little bit more than 11%. So, yeah, it's quite the tapestry of performance through the year, but mostly being driven by things like listing numbers starting to normalize through the second half of the year, affordability pressures becoming more prevalent, migration rates peaking from overseas and then starting to fall back, and rental markets, of course, remaining tight as a drum. That's really influenced a lot of buying behavior, as well as renters look to do whatever they can to get out of the rental market, it seems.
It was quite an interest, as you put it, an interesting convergence of these factors all really coming in. I feel like they came into play the second half of the year more so than the first. Is that a correct thing to say, that we did see quite a different period, I guess, through to June of 2023 than what we did see off the back end of the year?
I think that's highly relevant for markets like Sydney and Melbourne. Sydney really started this recent growth trend. It bottomed out in January of 2023, and values are rocketing through the first half of 2023 up until the first rate hike, or not the first in the cycle, of course, but the first rate hike of 23 was in June. And of course, or in May, and we saw housing values really started to slow down their rate of growth across Sydney and Melbourne at that stage. But other markets like Perth, Brisbane, Adelaide didn't seem to get too impacted by higher interest rates, both in June and in October. In fact, Perth was really accelerating through the second half of the year, as housing values over there are quite affordable compared to some of the larger markets. Interstate migration was really driving demand alongside overseas migration. Rental markets were showing a vacancy rate of around 0.5%, and rents were rising quite quickly. There's a lot of interstate investment happening as well. So again, it's different from region to region, but Sydney and Melbourne definitely showed quite a marked slowdown through the second half of last year.
Interesting to note. We're about to find out what you expect, Tim, from 2024, but we're going to take a quick break first. See you on the other side. Welcome back to this episode of the Smart Property Investment Show. I am lucky enough to be joined by Tim Lawless, an absolute expert and the Executive Research Director at CoreLogic's Asia Pacific Research Division. Again, Tim, thank you so much for taking the time. This obviously would be a pretty busy period for you with all of the expectations and the forecasts and the just people wanting to know what's happening in the year ahead. So we are very lucky to have you with us today, talking through a really, really measured approach, I'm going to say, to what people can expect from 2024, given the data that you have on hand. And some of this data, Tim, I mean, this would be years in the making, wouldn't it? That some of the expectations you've got from 2024, it's no small accident that you can make the predictions or talk about the expectations that you do.
Absolutely. I mean, forecasting anything is hard. Forecasting property markets, probably impossible to get it right all the time, because what you're really trying to do when you're forecasting housing trends is you're forecasting where interest rates are going, what consumer sentiment's likely to be doing, what's happening with credit availability, and of course, with the balance of housing supply and demand. So essentially, a housing forecast is rooted in a macroeconomic forecast at the very beginning. So you'll find that across the economic ecosystem, there's going to be a whole range of forecasts in the marketplace, ranging from conservative to quite bullish, depending on who's putting them out there. But But I think it's fair to say when we look into 2024, what we could be seeing is a year of two halves. I think the first half of the year could be a continuation of the trends we're seeing late last year, which was generally a deceleration in the rate of growth across the larger capital cities, as well as some of the smaller cities like Hobart and Canberra, really flattening out, if not going backwards, with some strength in the more affordable and smaller markets like Perth, Brisbane, to a lesser extent, Adelaide. With the second half of the year, hopefully by then we're starting to see more evidence that inflation's getting closer to the RBA's target range of 2 to 3%. Coming into late last year, inflation was getting down around the mid fours, which is certainly quite compelling given where it was early in the year, and inflation peaked above 8%. So if you do see inflation continuing on this trajectory, I think we'll start to see more calls that interest rates are going to be coming down in late 2024. In fact, we're already seeing financial markets fully pricing in a rate cut by October. Look out for the inflation data that comes out quite shortly. If we do see another fairly strong reading for inflation, meaning it comes in lower than expected, then I wouldn't be surprised if we see some of those rate cut forecasts even being brought forward a little bit. So I think they'll be the key factors to watch for. What happens with inflation? What happens with interest rates? And if we do see signs of interest rates coming down, does that also mean that APRA might loosen up on their serviceability buffer, which is currently at 3 percentage points? If we did see that reduce back to, say, maybe 2.5 percentage points, that just makes credit much more available, and serviceability for lenders or for borrowers applying for a loan becomes a little bit easier as well. Amid also less cost of living pressures, which we know have been really weighing on household budgets as well.
I think there's a lot of people right now who are loving what you're saying, Tim, and are hoping that it all does come to fruition, because it all really does spell good news for the investors out there. Something that you did pick up on, Tim, was around that affordability piece and really the internal migration across state borderlines to those more affordable markets. And this is something I think that probably it's always obviously been the case that people do move where they can afford property, but I feel like it really came to light during COVID, not only as an affordability concern, but as a lifestyle and a livability concern as well. Do you think that is something that we're gonna see continuing?
Well, maybe I can start here. I think housing affordability absolutely is going to be front and center from a policy perspective this year and into next year, especially from a housing supply perspective. We know that the government's very focused on trying to get more housing supply into the marketplace, but there's a lot of challenges in doing so. But when we look at affordability, clearly it's different from region to region and city to city. You've got at one end of the spectrum, a market like Sydney. Typical price of a house in Sydney is $1.4 million now. If you look at that and sort of adjusting for incomes, the dwelling value to income ratio in Sydney is about 9.4. And that simply means that the typical household in Sydney is spending 9.4 times their gross annual household income to buy the median price dwelling. At the other end of the spectrum, you've got a market like Perth. You've got a median house value in Perth. It's about $691,000. Less than half of what it is in Sydney. You've got a dwelling value to income ratio in Perth, it's 5.9, so a little bit less than 6. And of course, Perth is a marketplace that's performing very well because of its affordability, but also because it has a strong economy as well. That's probably the key thing to keep in mind here is that, because a housing market's affordable, that doesn't necessarily promote growth. It needs to have a mixture of other elements as well that brings in demand. So a mixture or a recipe of housing affordability plus strong economic conditions, low unemployment and job prospects, that's where you start to see a real, proliferation of capital gains coming into a market. And more people, as you say, Grace, more people leaving regions to move across the state borders. And we can clearly see that in Western Australia, a very strong rate of interstate migration. Same with Queensland. Again, a relatively affordable marketplace, although not as affordable as Perth, but it's that blend of affordability plus jobs that really drives housing demand.
There you go. So sounds like Perth or really anywhere across in WA and Queensland are doing well. What are you expecting from the other states or cities? What can you share with us, Tim? I understand there's probably only so much you can crystal ball gaze on, but what are you expecting over the next 11, 12 months?
Well, I think from a fairly macro perspective, I think the fact that we're still seeing an undersupply of housing is going to be beneficial for housing prices, at least putting some upwards pressure on housing prices, or at the very least keeping a floor under prices in some markets. So you've got that housing undersupply, which is likely to continue to be a positive influence on housing prices. But you've also got a slowdown in overseas migration from record highs, of course. So if you think about the key markets that benefit from overseas migration, that's Melbourne and Sydney, they'll probably start to see a little bit of an easing up in their rental markets, simply because we see most of that overseas migration flows through to rental demand, at least over the short to medium term, rather than purchasing demand. But there is a bit of a lag. So again, with those two cities that have experienced such strong overseas migration, typically you'd expect the permanent to long-term migrants to start flowing into a home purchasing decision within a couple of years of their arrival. So we should start to see the impact of that in those two cities, which will help to drive housing demand, despite the fact that particularly Sydney is a relatively unaffordable market. Melbourne, on the other hand, is also building up quite an affordability advantage. Remember, Melbourne has seen a much softer growth cycle than most other capital cities through the pandemic all the way through to now. In fact, if you look at some of those figures just on how much housing values have risen through the pandemic to date, Melbourne's up about 11%. I mean, that in itself is relatively strong. Sydney's up about 25%, but some markets like Adelaide's up 53%, Brisbane's up 50%, Perth's up 47%. So you can see that Melbourne being up a fairly mild amount, while that's probably not great news for homeowners or investors in that area, it does mean that market's building up quite a strong affordability competitive advantage compared to other markets like Sydney. So I wouldn't be surprised if Melbourne does pick up a little bit given its weaker performance and its underlying strength in terms of its fundamentals. I think markets that you might want to be maybe a little bit cautious about through the year are going to be markets like Hobart, where we know it's had a very strong recent trajectory of growth over the past 5 to 7 years. It's become very unaffordable. It doesn't have the same sort of growth drivers of overseas migration or interstate migration coming into that market. In fact, interstate migration is now, once again, negative across Tassie. The ACT, another market, has been quite weak, and it seems that they've done a much better job of bringing supply into the marketplace as well, which is probably one of the reasons why growth is fairly flat across that marketplace. And then the regional markets. The regional markets have generally underperformed the capital cities, again, after overperforming. But I wouldn't be surprised if in 2024, we do start to see regional markets just bouncing back a little bit more strongly, given that renewed affordability advantage they've built up through last year, and the fact that we're still seeing, regional commutable markets that are quite, livable, have a lifestyle advantage, still seem to be quite popular as well. So that'd be my pick for regional markets, would be those areas that are in that sweet spot of being commutable and have a lifestyle dividend associated with them, and maybe have seen a fairly significant pullback in their values after they rocketed higher through the pandemic. I wouldn't be surprised if they show a reasonable outcome as well.
Well, there you go. To everyone listening along, I hope you are taking some notes. We're going to take a quick break, but there's still more to come from Tim Lawless on the other side. See you soon. Welcome back to this episode of the Smart Property Investment Show. As you know, I am joined by Tim Lawless, Executive Research Director over at CoreLogic. And Tim, it's been so great to hear your insights today. Thank you so much for sharing them with us. One thing you brought up just before the break that I wouldn't mind getting you to expand upon is around the issue of housing supply that has been all that anyone seems to have talked about for the last, especially 6 months, but definitely longer than that. Where do you see us as being at this point in time? Because obviously having heightened demand and no supply is not really there's not really a good formula in there for the future of property. So where to from here?
Yeah, it is unhealthy. And I know a lot of people, a lot of investors will be looking for markets that are undersupplied because it is a driver of growth. Absolutely, it does place upwards pressure on housing prices. But the medium to long-term social outcomes of a housing undersupply are significant as well. It generally means worsening affordability. It means rental markets tend to be really tight. That homelessness and couch surfing and rough living all become more prevalent. So overall, this is a fairly significantly negative outcome, and no surprise to see it's such a policy initiative from federal, state, and local governments. So maybe to put this into context, remember the Housing Accord, which we saw back in 2023, or maybe it was 2022. This was originally announced. The federal government had this aspirational target of 1.2 million homes to be built over 5 years. That goal goes live this year from July. And it's looking like it's going to be really hard to achieve. In corporate world, we all know that having a stretch target is really good. It gives you something to work towards, and it's aspirational. And I think that's how I describe that 1.2 million target is it's a stretch target. If you can get there, fantastic, but it's something to work towards. But the reason I think it's going to be really hard to achieve is we're currently seeing dwelling approvals, the earliest phase of new supply coming into the marketplace. Generally, month to month, we're seeing roughly around about 14,000 approvals coming through a month. In order to achieve that 1.2 million target over 5 years, approvals need to be consistently at 20,000 a month. So they're way underperforming at the moment and not really showing any sign of starting to lift. Of course, it comes after the home builder program that saw a lot of new supply coming into the market, but it also broke the market a little bit. There were supply chain constraints, construction costs rocketed higher. And that's still the legacy of that previous phase in the construction cycle, is that builders are just finding it hard to attain a profit margin amid high construction costs and really tight labor demand. So I think the outlook for supply, or at least over the short to medium term, is still looking pretty glum. We're not expecting there to be a significant uplift in construction activity, particularly the early phases. It still takes, at least for, say, an apartment building, generally 18 to 24 months to get an apartment building out of the ground. It's probably longer than that now, given some of the blowouts in timeframes. Houses a little bit less than that. So long story short, just looking at commencements data from the ABS, every state is still seeing dwelling commencements running way below average. We're not seeing any sign of that turning around, which is why I think we'll probably end 2024 and maybe even 2025 in a fairly chronic undersupply. But until we start to see a turnaround in approvals, we're not going to see any hope that we're going to achieve that 1.2 million target anytime soon.
Well, that's not the most optimistic outlook, but it can make so much sense, Tim. And hopefully we do start seeing some of those numbers tick over. There's a lot of efforts being made by all levels of government on that. We hope that we can get that supply up, because really, at the end of the day, it's an infrastructure issue and getting those homes available for people. But Tim, thank you for shining a light on some of that as well, because it is hard to wade through all the information out there and actually work out whether we're on track or not. So knowing that there's the data there is half the battle to begin with. So Tim, I can't let you go without talking to you about the rental market. That's obviously what has been talked about, especially in response to the housing supply issue, the fact that there is a chronic shortage of rental properties out there. It did get very tight over the course of 2023. And I know there are investors out there that are looking to put homes and properties on the market to try and change this. Very, very hard to do when it's more of a systemic issue than that. But what are you expecting from the rental market over the next 12 months?
Well, I think rents overall will remain quite strong. Remember last year, we were seeing at a fairly macro level, at least, house rents were rising at nearly 8% per annum, unit rents about 10% per annum, was showing some signs of losing momentum, I think is fair to say, and also greater diversity. So I don't think we'll see rents rising quite that much this year, but still well above average levels of rental growth, considering vacancy rates are still generally around 1%, if not lower than that, across most markets. There are a few outliers, like rents are going backwards now in Hobart and Canberra. As I mentioned before, they've done a much better job of or particularly Canberra, introducing more supply into the market, but Hobart's more about rental demand slowing down. But again, Perth really stands out for me for the strongest rental conditions. And I think this will remain the case into 2024 and 25. Perth house rents are up 13% last year, unit rents up nearly 17% over the year. And like most other capital cities that are slowing down, Perth is bucking the trend. It's not really showing any evidence of rental rates slowing down. Melbourne, also a really strong rental market. It's another city where vacancy rates are below 1%. House rents rising about 11% per annum. Unit rents also about 11% per annum. That'll probably slow down a little bit, I'd say, in the unit sector, given the slowdown in net overseas migration rates. But overall, we look for any changes in rental supply. Rental listings remain really low, suggests to me vacancy rates will remain very tight. But on the demand side, we probably will see some further changes in household composition. So what I mean by that is rental demand probably easing off as we see more group households forming, rental households that disaggregated through the pandemic, reforming. So through the pandemic, we did see household size fell quite sharply, and that really amplified rental demand. That seems to be slowly normalizing now as we see more group households, more multi-generational households, maybe some younger folks staying at home in the family household a bit longer, as well as the fact that, of course, in rental markets, we could see a little bit less demand as more people who are renting, waiting for their house to be finished from the home builder program. Finally, we're starting to see those completions rolling through a little bit more rapidly now. And that could take away a little bit of rental demand as well. But overall, from a very tight position, and I think rents will remain rising at well above average rates in most of the major capitals.
Well, there you go. There's some good news for investors. One of the things I asked you earlier, Tim, was just around whether you'd seen a market as interesting as this one before. And I'm curious when it comes to the rental market and these super, super low vacancy rates. Have you seen it like that before?
No, absolutely not. I mean, rental markets in technical terms seem to be a little bit broken at the moment. Typically rents would rise at a fairly steady and moderate rates. Historically, before the pandemic, rents were typically rising at around maybe 2 to 5% per annum, depending on which area you're looking at. Roughly in line with household income growth, a little bit higher than inflation. So to see rents rising in double-digit figures for a couple of years now is really, really different. You can understand why renters are feeling so much pressure amid broader cost of living pressures, with rents going up so much after such a long period where rents didn't really do too much at all. So again, this all just simply comes down to supply and demand being completely out of balance. And I just can't see that being fixed over the short term, unfortunately, for renters.
It very much feels like something that people are going to be researching and writing about for years to come, just this strange, as I said before, convergence of factors that are coming in. So yeah, maybe this is one for the history books. Tim, thank you so much for sharing your insights with us today. I'm already looking forward to the next time we get to chat, and we really, really do appreciate it.
Many thanks, Grace. It's been a wonderful interview. And again, thanks for the invitation.
To everyone who is listening along, we hope you have enjoyed this episode. Like or review us on whatever platform that you listen to your podcasts on. If you have any questions, don't hesitate to reach out, editor@smartpropertyinvestment.com.au. And if you or someone you know might make a good guest for an upcoming episode, we always want to hear from investors out there. Please don't hesitate to reach out. Always also on that email, editor@smartpropertyinvestment.com.au. Until next time, stay safe and well wherever you're listening from. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.